Steve had asked, isn't the married put the same as a long call, low risk, and about the same price considering the cost of money? Let me go to YouTube, Steve, real quick here. First, so I'm going to go to our YouTube channel here. I'm on the Power Options YouTube channel. Go in the Power Options YouTube channel, use that search function, and just type in long call versus, okay, long call versus the married put. Is this a parity trade? No, it is not. In my opinion, and every time I say this, we get some good comments on people saying, yes, it is, no, it isn't, yes, it is, no, and yes and no. You can look at it two ways. In the earlier presentation, Steve, I had made, I'm sorry, going the wrong direction here, and you're not seeing my screen, I know, but I made sort of, we made a comment here when we were talking about the question for Mike. I'm sorry, it was for Mike. And we talked about, wait, spreads are low risk. Credit spreads and debit spreads, condors and butterfly, buying calls, buying puts, ratio back spreads. These are known risk trades. They're not low risk unless you're disciplined. So is that the only answer? No, there's more to it. And that's why we have the videos here. Out on the money, long call, but that's not it. But the long call versus married put, are these a parity trades? Do the profit and loss chart, Steve, and the risk look the same? Absolutely. What do I mean by that? Well, let's go to the profit and loss chart for my married put on a firm. Going far out in time, I would have put up $9,220 to enter this position. I have $10,000 of free capital in my portfolio. I'm bullish on a firm. I am going to enter this married put position. Yeah, I'm risking 16% again. It would have been a higher cost. I would have gone with the 80 strike put for probably $6 or $7 more, but it would have dropped the risk down to 8, 9, 10%. Okay, like I said, Steve, normally I don't go above 8% on my risk with the positions I'm looking for. I could have gone with the May, which is more likely, or even the April was right around, I think, at 150 days out in time when it was available. Well, let's take a quick look. I know that I went onto the historical chain and the midpoint, I want to be fair, the midpoint on October 21st at the close of the Affirm June 77.5 put was $17.7. All right, I have $10,000 of free capital in my account, Steve. I'm opening this married put. The most I can lose is $1,470 maximum risk on the trade. Let's go to the option chain first. Okay, let's go back. And while you're on the trial, you have access to 3 months of the historical data. I want to go back to October 21st. And we got to look at June expiration. Yeah, see, the March was it was March that was 150. My apologies. So I would have gone with the March or the May, probably the 80 strike for that lower risk. But we'll keep with our example here. June 18th, 240. Calls and puts, right? I'm on calls and puts. Perfect. And I bought the 77.5 strike for a total cost of $17.70. It was slightly in the money, Steve. But and you can see it right here, $17.70. That's the midpoint of the June 77.5 strike. You know I'm risking $14.70 on the trade. Just the time value. Fair comparison using midpoint pricing. $16.30 was the midpoint of our 77 strike call. All right, so I'm going to buy one call at $16.30 because I bought 100 shares of a firm. And my risk is $14.70. So I'm going to have a $160 higher cost. Again, what is the profit and loss chart of my married put? We're looking here at the halfway point on February 20th. Break even here is the break even only at expiration. If I hold the married put all the way to expiration, make no adjustments on the trade, don't sell any calls, don't accept any dividends. If a firm pays a dividend, don't adjust the put. I need the stock to be above 92.20. All right. But we saw that at the same time, closing prices, our June, same strike, 77.5 strike call, was priced at $16.30. All right, so the argument, the long call is the same thing as a married put, but it's lower risk and has about the same price considering the cost of money. Yep. It's about the same. In this case, at midpoint, Steve, is just about $160 higher. And what do I have? Unlimited upside with a break even at 93.80 instead of, what was it, 92.20? Yeah, 92.20, Steve, sorry. It's just a little bit difference with the bid-ask spreads. You see you're $1.60 higher, nothing to cry about, one way or the other, right? Okay. And he says, less as there is not cost to carry the stock. Okay. I agree. The profit and loss chart are similar. Unlimited upside, known risk, in this case, of 93.80. Steve's a trader. Steve's an investor. Steve's looking to make money. I had $10,000 in my account. I spent $9,220 to buy a firm 100 shares at $74.50 and a June 77.5 put at $17.70, my apologies. But the maximum risk was only $1,470, or roughly 16% of close to the $10,000 I invested in the position. Steve doesn't want the cost of carrying the stock, so it's going to be a better position. It's less cost to carry it. It's the same trade to just buy the 1630 call. Now you're sitting on $8,370, not in the market. Cool. But what are you likely going to do now, Steve? You might decide that, hey, if I was willing to risk $1,600, I might be willing to risk $3,200. I'm going to buy 2 calls here, and that would leave me with $6,800. And then I might buy another 1 or 2 calls on stocks ABC, XYZ, 1, 2, 3, or maybe I'll do some bull put credit spreads or iron condor positions, which are low risk trades. With after I buy these calls, I have $4,000 left, so I'm going to do 2-point spreads here on maybe SPY or something, on an iron condor or on a bull put credit spread. I do 5 to 10 contracts of each. So now I've got bullish, neutral, and other bullish calls here in the market on these positions. And I've invested $8,750 of the $10,000 that I had. Am I still at low risk trades? No, I'm exposing 87.5% of the free capital I had in the market on various trades, because that's the nature of the investor. $10,000 of free capital. I'm risking $14.70. Carrying the price of the stock, if it pays a dividend, even better. I don't think a firm does, Steve, by the way. And I'm not saying that the profit and loss charts aren't similar, that the risk rewards at first glance aren't similar with buying a long call, paying $16.30 for it, and my married put, which was risking $14.70. What we're saying as the nature of the trader, and I talked about this in that last slide, it's only low risk if you are disciplined, practice proper position sizing, and don't overexpose yourself by saying, hey, I'm pretty sure I'm going to profit on a firm, so I'm going to buy 1 call or 2 calls here, increasing the risk, but I'm also going to buy calls on ABC, XYZ, maybe an iron condor here, maybe a bull put credit here. All of these are leverage trades that have 100% risk of what you invested in the trade. And in any kind of uncertain or black swan event, you're going to be risking much more of that initial free capital that you had. The true, quote unquote, if you're trying to say that the married put and the long call are parity trades, the only way that a long call is actually a parity trade to the married put position is if you had that $10,000 in your account, Steve, of free capital, and you bought this June 77.5 call when you saw me post on Fusion that I bought the June 77.5 put with paying $74.50 per share. It's only a parity trade if and only if after buying this call at $16.30, you take the remaining capital of $8,370, or the more likely what I'd say is the $7,450 it would have cost to buy shares of stock, and you leave this on hold in your account, not using it for other trades, not exposing it to the market the entire time you're in this long call. Because now you're risking $16.30. You've put this $7,450 aside. You're risking $16.30 of what you had of $10,000, which is 16.3%, very similar of the 15.9% I was risking on the trade. That is the only way that they are parity trades. If you put the capital aside, on hold, and don't use it. But that's not what investors do. And that's why investors get into trouble. And that's why I always use that phrase, Steve, that spread trades, buying calls, buying puts are not low risk. They are known risk. They're only low risk if you apply the proper discipline. That's one of the advantages of the married puts. And again, do I trade long calls? Do I trade bull put credit spreads? Do I just buy long puts when I see the market sentiment? Do I buy calls on the VIX when I see the market sentiment go to sell warnings? Yes, I do. But with only about 2 or 3% of my total portfolio value, because I know I'm risking 100% of what I paid in case some other news comes out and the market snaps back and goes the other direction. You can see that in a little bit more detail, a little bit more discussion, Steve, as I mentioned. Go to Power Options, go to long call versus, that's all you have to enter in the search in our magnifying glass. Check out this long call versus married put for 2 years ago. Comment there, send me an email, comment here if you disagree with me. You know, I just, this is why we talk about these comparisons, because in the last 6 months, if I just took $10,000, just bought calls, I probably would have done pretty good. The beginning of the year, if I had done that, just bought calls, well, I probably would have down 90, 75% in April, 80% of my portfolio in April, even with management techniques, because I didn't pay attention to the signals. I'm not saying you're not, Steve. Don't get me wrong. You and I have had conversations before. I know you watch the signals. I know you're looking for the good bullish stocks. But again, it's just, you have to have that in there. Okay. But that's the case. And Steve says he disagrees. He says, thank you for the explanation. I disagree as I understand sizing. That's fine, Steve. That's okay. That's perfectly fine. But that's our thoughts on it. Why we don't consider, I do not consider the married put, I don't consider a long call, Steve, to the married put as a parity trade. It's only a parity trade if you put the money aside that we would have used to buy the stock. So you're doing the same percentage risk of the total portfolio that you would have had in the married put. Otherwise, 90%, 80% of investors I've talked to over the years who tell me about that comparison, then they just go out and they just start buying more calls, start entering more strategies. They're risking 75 to 80% of the $10,000 they had in their portfolio, where I'm only risking 4, 5, or 6%. But again, the married puts are not the only thing I do, Steve. It's just about 45 to 50, 55% of my total portfolio. The rest is based on these strategies, but it's got to be proper position sizing. And that's where a lot of people get hurt, because they don't use proper position sizing.